Welcome to 1972. Imagine a world where everyone is wearing too much brown. The air smells faintly of leaded gasoline. And the stock market is a place where you literally cannot lose money. At least, that's what the guys in the skinny ties and thick-rimmed glasses at Morgan Guaranty and Northern Trust were telling everyone. They had discovered the financial equivalent of the Holy Grail. They called it the asterisk Nifty 50. The Nifty 50 weren't just stocks, they were the aristocrats of the American dream. We're talking about names like Disney, McDonald's, Xerox, Kodak, Polaroid, and IBM. These were the blue chips of all blue chips. They were the companies that built the modern world. They had dominant market shares, fortress balance sheets, and earnings growth that looked like a staircase to heaven. But the most dangerous thing about the Nifty 50 wasn't the companies themselves. It was the asterisk philosophy that formed around them. Wall Street called them one-decision stocks. The logic was simple, seductive, and completely idiotic. You only had to make one decision, asterisk to buy asterisk. You never had to make the second decision, asterisk to sell asterisk. Because these companies were so nifty, so invincible, and so certain to grow forever. The price you paid for them today didn't actually matter. If you bought Disney at a P/E ratio of 80, who cared? In 10 years, the earnings would catch up and you'd be rich. Valuation was for losers. Math was for people who didn't understand the new era. By the peak of the frenzy in late 1972, the concentration was staggering. These 50 stocks made up nearly asterisk 45% of the total value of the S&P 500 asterisk. Think about that for a second. There are 500 companies in the index, but 50 of them, the cool kids at the lunch table, owned almost half of the entire American economy's valuation. The other 450 companies were just background noise. They were the old economy. They were boring, they were ignored. The institutional managers were hurting. If you were a fund manager in 1972 and you didn't own Xerox or Avon, you weren't just unconventional. B letter 1ED1, B letter 1EA1N, you were considered incompetent. You were fired for not participating in the miracle. And so, everyone bought because everyone else was buying. It was a self-fulfilling prophecy of invincibility. Now, let's fast forward to today. Look at the Mag 7. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Sound familiar? They are the dominant market leaders. They have fortress balance sheets. They are the one-decision stocks of the 2020s. We are told that AI is a once-in-a-generation revolution, and that these companies are the only ones that matter. Today, the Magnificent Seven make up around asterisk 36% of the S&P 500 asterisk. We haven't quite hit the 45% insanity of 1972 yet, but we are sprinting toward it with our eyes closed and our pockets open. In 1972, the Nifty 50 traded at an average P/E ratio of about 42. That doesn't sound too crazy until you look at the outliers. Polaroid asterisk was trading at 90 times earnings. McDonald's was at 80. Disney asterisk was at 70. Investors justified this by saying these companies were different. They weren't cyclical, they were growth machines. Today, we see the same behavior. When Nvidia adds $1 trillion to its market cap in a few weeks, we don't ask if the valuation makes sense based on historical cash flows. We say, well, the demand for H100 chips is infinite, and AI is the new electricity. We are using the exact same new paradigm, language that the polyester-clad fund managers used in 1972. We have replaced color film and photocopying with large language models and autonomous driving, but the psychological delusion remains identical. The Nifty 50 bubble wasn't a bubble of bad companies. Xerox was a great company. Kodak was a giant. The bubble was in the asterisk certainty, asterisk. It was the belief that a great company is a great investment at any asterisk price. But as history is about to show us, and as 1973 proved with brutal efficiency, price is the only thing that actually matters in the end. When the one decision, crowd finally decides to make that second decision, there usually isn't anyone left to buy. In early 1973, the Nifty 50 investors were feeling like gods. They were sipping martinis, looking at their portfolios, and laughing at the value investors who were still holding onto boring things like oil or steel. Then reality arrived. And it didn't knock, it kicked the door down. The crash of 1970 through 1974 wasn't a single flash crash. It was a slow, agonizing meat grinder that lasted 694 days. It was a systematic dismantling of the one decision myth. 3 things hit at once, and they look hauntingly familiar today. 1. Inflation spiked. Asterisk, the consumer price index went from 3% to 12%. 2. The oil crisis. Asterisk, the OPEC embargo sent energy prices through the roof, proving that even invincible growth companies have to pay for electricity and transport. 3. Interest rates soared. The Fed was forced to crank rates up to fight inflation, which is the financial equivalent of sucking the oxygen out of a room filled with high PE stocks. When interest rates go up, the future earnings of a high-growth stock become worth much less in today's dollars. Suddenly, paying 90 times earnings for Polaroid didn't look like a visionary move. It looked like a suicide pact. The carnage was breathtaking. By the time the dust settled in late 1974, Xerox ***, the AI of its day, had dropped ***, 71%***. Avon ***, the dominant consumer brand, was down *86%***. Polaroid ***, the tech darling, crumbled by *91%**. These weren't meme stocks. These weren't crypto scams. These were the largest, most respected companies on the planet. The S&P 500 lost nearly 50% of its value. But the Nifty 50, the supposed safe haven, fell much harder. Joe the Stickman, who bought Disney at the top because people will always take their kids to Disneyland, watched his life savings shrink by 70%. Disney was still a great company. People were still going to Disneyland. But the stock was a disaster because the starting price was a hallucination. So if this happened before, why is the Mag 7 trade currently the most crowded room in financial history? Why is history repeating itself while everyone stares at their iPhones? Because of the "this time is different" asterisk syndrome. Today, the bulls argue that the Magnificent Seven have higher profit margins and better cash flows than the Nifty 50 did. And they're right on paper. But they are missing the forest for the AI-generated trees. In 1972, you had a few dozen big banks buying the same stocks. Today, we have passive indexation ***. When you buy an S&P 500 index fund today, for every $100 you invest, nearly $36 goes straight into those 7 tech companies. You aren't diversifying. You are piling into a crowded elevator. Fund managers are in a performance trap. If they don't own NVIDIA and it goes up another 20%, they look like idiots and their clients leave. So they buy it not because they love the valuation, but because they are terrified of being left behind. It's a game of musical chairs, where the music is being played by an AI algorithm. At 2x speed, we've had a decade of low interest rates and tech exceptionalism. We've been conditioned to believe that software eats the world and that big tech is a utility like water. But the 1973 crash proved that no company is a utility if the price is high. Enough. Nobody remembers 1973 because the survivors don't like to talk about it. And the losers aren't around to tell the story. We've replaced the one decision stocks of 1972 with the unstoppable 7 of Today, ignoring the fact that the more people agree on a sure thing, the more dangerous that thing becomes. The most haunting lesson of the Nifty 50 isn't just that they crashed, it's what happened to them after the crash. If you had bought the Nifty 50 at the peak in 1972, even if you hodled for decades, your recovery was agonizingly slow. For many of these immortal companies, the 1973 crash was the beginning of a long, slow walk into irrelevance. Look at Kodak. In 1972, it was the king of imaging. It was a one-decision stock because everyone will always need to take photos fast forward. And Kodak is a cautionary tale of bankruptcy and missed transitions. Look at Xerox. It went from a verb and a market god to a struggling hardware company that hasn't seen its 1972 split-adjusted highs in any meaningful way. Relative to inflation, the one-decision philosophy assumes that the world stays the same. It assumes that the Mag 7 will dominate AI, and that AI will look exactly like they think it will. But in 1972, they couldn't imagine the digital camera killing Kodak or the personal computer neutralizing Xerox. They mistook a temporary period of dominance for a permanent law of nature. The echo today, we are currently standing in a room mirrored with the ghosts of 1972. We see the same concentration. We see the same buy and forget mentality. We see the same dismissive attitude toward anyone who mentions the word valuation. When the S&P 500 is 36% concentrated in 7 names, you aren't betting on the American economy anymore. You are betting on 7 management teams and one specific technological narrative. If history rhymes, the unwinding won't happen because these companies become bad companies. It will happen because they fail to meet the impossible expectations baked into their stock prices. Resolution. The second decision, the 1973 stock market crash, was a brutal reminder that in finance, there is no such thing as a one-decision stock. Every day you hold a stock, you are making a second decision, the decision that today's price is still worth the risk. In 1972, people forgot how to make that second decision. They outsourced their thinking to the herd. In 2026, as we watch the magnificent 7 swallow the market, the question isn't whether AI is real or whether Apple makes good phones. The question is, have we forgotten how to think for ourselves again? History doesn't repeat, but it definitely screams. And right now, the echo of 1973 is getting very, very loud. The Nifty 50 taught us that blue chip is just a fancy name for a stock that hasn't crashed yet. Don't let the Mag 7 be the last thing you remember before the lights go out.